Welcome to Chapter 2, Financial Statements and Accounting Concepts Principles. Remember, this is not your first exposure to most, if not all, of this material. In this chapter, we're going to talk about what transactions are, identify and explain the kind of information that's reported in the financial statements, and how those financial statements are related to one another. Explain the meaning and usefulness of the accounting equation. Explain the meaning of each of the captions on the financial statements that are illustrated in the chapter. Identify and explain the broad and generally accepted concepts and principles that apply to the accounting process. Discuss why investors have to carefully consider things like cash flow in conjunction with accrual accounting results. Identify and explain some of the limitations of the financial statements. And describe to you what a basic corporation's annual report is and why it is issued. The process of accruing accounting information starts with transactions. Transactions are economic interchanges between entities that are accounted for and reflected in the financial statements. The term economic interchange means that something of value has been given up by one entity in exchange for something else of equal value. So an example of this is when an organization uses cash to pay employee wages. The organization gives up cash, something of value, to pay the employee to produce a product, something else of value, the employee's time. While the employee gives up time to produce the product in exchange for wages for his or her labor. So an economic interchange has occurred. Another example of this is the borrowing of cash from a bank, sales of merchandise, purchases of inventory, cash receipts for goods sold, and cash payments for supplies and merchandise. By no means are these the only transactions. These are just some examples for you to recall what a transaction is. Recording transactions, the economic interchanges between an entity and other organizations and or individuals, requires both bookkeeping and accounting functions. The flow begins with the bookkeeping functions. Procedures for sorting, classifying, and presenting the transactions, and continues with the accounting functions of selecting among alternative methods, of reflecting the transactions and the effects of those transactions. Eventually, the entity's financial statements are the end product of all of these processes. Let's start by talking about accounts. So accounts are transactions, holding places. Transactions get summarized into accounts and are used to organize like-kind transactions. So transactions that affect cash, transactions that affect accounts receivables, transactions that affect accounts payables. These are like the files in the file folders inside a filing cabinet. The account balances at a specific point in time are used in the preparation of the financial statements. There are four general purpose financial statements. They are the balance sheet, and this presents the financial position of an entity at the end of an accounting period. This is the statement of financial position is another set of words we use to describe it. The income statement reports the earnings of an entity for an accounting period and has also been called the statement of earnings, the profit and loss statement, or the statement of operations. The statement of cash flows shows the cash inflows and outflows during a period. And the statement of changes in stockholders' equity reports the investments and distributions to owners during a period. This can also be called the statement of changes in capital stock or the statement of changes in retained earnings. These four financial statements are contained in the annual report, and that report will also include several notes, explanations, additional disclosures of accounting policies used, and detailed information about amounts and captions shown in the financial statements. Let's talk a little bit about each of these statements. We'll start with the balance sheet or the statement of financial position. This is a snapshot at a given point in time. You will notice that in the heading, it is a very specific date. The balance sheet's a listing of the organization's asset, liabilities, and equities at a point in time. Assets represent the amount of resources owned by an entity, the probable future economic benefits obtained or controlled by the entity as a result of past transactions or events. Liabilities are those amounts owed to other entities, the probable future sacrifices of the entity's economic benefits arising from present obligations to transfer assets or provide services to other entities in the future as a result of past transactions or events. And stockholders' equity is the stockholders' ownership in the assets of an entity that remain after deducting the liabilities. Stockholders' equity is often referred to as net assets. Assets minus liabilities equals stockholders' equity. So let's just take a little bit more of a look at the balance sheet. You'll recall that the accounting equation is assets equals liabilities plus stockholders' equity. The balance sheet actually presents the balances in an entity's accounts at a given point in time using this same equation. Assets, so total assets of $320,000 equals liabilities plus equity. We take the total liabilities of $117,000, add the stockholders' equity at $203,000, and that is also $320,000. So we have assets of $320,000, and we have claims on those assets in the forms of liabilities or stockholders' equity of $320,000. We are in balance. At all times, the balance sheet equation must balance. If it is not in balance, then there is an error somewhere, and you must find it. Total assets include both current and long-lived assets. You have additional information on these different accounts and some examples of all of them in your text. Total liabilities include both current and long-term liabilities. Total liabilities combined with stockholders' equity absolutely must equal total assets. Continuing to move forward with the balance sheet, we'll talk a little bit here about current assets. Current assets are those assets that are likely to be converted into cash or used to benefit the entity within 1 year. Current assets include cash, accounts receivable, merchandise inventory, and a host of others that are less common. The plant and equipment account, or property, plants, and equipment, includes long-term assets that will benefit the entity over several years. You'll notice the account accumulated depreciation, which represents the portion of the cost of the equipment that is estimated to have been used up in the process of operating the business. Depreciation in accounting is the process of spreading the cost of an asset over its useful life of the entity. It's not an attempt to recognize the economic loss in value of the asset because of its age or use. It is solely a cost allocation method. Current liabilities represent amounts borrowed that will be repaid within 1 year of the balance sheet date. Current liabilities include short-term debt, accounts payable, and other accrued liabilities. Long-term liabilities are those liabilities that will not be paid within 1 year of the balance sheet date. We go into greater detail for all of these in later chapters. Continuing to move forward, we have the income statement. This shows the net income or net loss for the period that we're looking at. This is the results for a period in time. Take note that the heading says it is for the year of August 31st, 2017. It's not on August 31st, 2017, and only what occurred then. It is for the period of the year ended August 31st, 2017. This is sometimes called the statement of earnings, profit and loss, or the statement of operations. The income statement reports revenues that result from the entity's operating activities and deducts the costs and expenses incurred in generating those revenues to arrive at a net income. This represents the profit and or loss for the period. Notice the statement starts with net sales, which are revenues. You may recall that can be called sales revenues. And that the various expenses are subtracted to arrive at net income. Income taxes are shown after all the other income statement items have been reported. Because income taxes, also potentially called the income tax expense or provision for income taxes, are a function of the firm's income before taxes. Last, you'll notice that there's an earnings per share of earnings per share of common stock outstanding. This is reported as a separate item at the bottom of the income statement and is required by GAAP. And that is because of its significance in evaluating the market value of a share of common stock. This does not mean that the stockholders will receive $1.80. This says that based on the common stock outstanding, this is how the investment was used in this period to generate earnings. The next statement, which also covers a period of time, is the statement of changes in stockholders' equity. This statement reports the details of stockholders' equity and explains the changes that occurred in paid-in capital and retained earnings during the period. Paid-in capital includes common stock at par value and additional paid-in capital. Retained earnings include the net income or loss reported by the entity since its inception or its birth, less any dividends that have been distributed to owners to date. This statement provides the details of the balances that are reported in the stockholders' equity section of the balance sheet. And finally, we have the statement of cash flows. This statement of cash flows details the inflows and outflows of cash during a period of time, which is typically 1 year. The inflows and outflows are separated into 3 distinct categories: operating activities, investing activities, and financing activities. Cash flows from operating activities consist of inflows and outflows of cash required to operate the business on a day-to-day basis. Inflows result from selling products, providing services. Outflows result from paying expenses that were needed to generate revenues, such as wages, rents, utilities, things of that nature. Cash flows from investing activities result from the organization using cash to purchase long-term assets such as equipment, building factories, or purchasing land. The long-term assets are acquired with the intention of increasing revenue. Inflows typically result from the sale of long-term operational assets. Cash flows from financing activities typically include borrowing or repayment of monies. Cash inflows from financing activities may come from investments from stockholders, the borrowing of funds from bondholders, and the borrowing of funds from a financial institution such as a bank. Outflows from financing activities may result from things such as the repayment of previously borrowed funds or the payment of cash dividends to stockholders. Here we have what we call the timeline model. And this explains some of the relationships and the models of how we have an interrelated relationship between the various financial statements. We start with the beginning balance sheet report. This reports assets, liabilities, and stockholders' equity account balances as the accounting period begins. So on August 31st, 2016. We create the income statement, which reports the revenue earned and the expenses that were incurred during that period. Net income is calculated and reported in the changes to the stockholders' equity. So we take net income from the income statement, and it becomes a factor in the statement of changes in stockholders' equity report. Net income is added to the beginning balance in the retained earnings, and any dividends are subtracted. The ending balance in the stockholders' equity is then reported on the end-of-year balance sheet. In addition, the statement of cash flows actually shows the increase or decrease in the cash account. When this is combined with the beginning balance, then the calculated balance is reported in the asset account cash in the ending balance sheet. Let's think about how some of these things occur. When you earn revenues, they have the effect of an increase on stockholders' equity. As we incur expenses, they're going to decrease our stockholders' equity because they're going to decrease net income. Expenses are absolute necessary evils in order for us to generate revenue. Dividends are the distribution of stockholders' equity to owners. Therefore, they will also decrease stockholders' equity, but they are never treated as an expense. Expenses are defined as costs that are associated with generating revenue. As distributions of profits from the organization to the investors, please never treat dividends as an expense. You will not see them on the income statement. The payment of dividends to investors has no correlation to the actual generation of revenue. This is a golden rule of accounting, and it's discussed in the conceptual framework that should absolutely never be ignored. So here we can see how the arrow indicates the net income affects retained earnings. Retained earnings is a component of stockholders' equity. We have a great little visual here that shows you how the different reports work. From the beginning balance sheet and how it flows over to different reports, to the income statement, to the statement of changes in stockholders' equity, to the statement of the current balance sheet or the current financial position. Finally, also the statement of cash flows. Your financial statements are the communication of the economic position and the economic transactions that occurred for an entity during a specific period of time. Utilizing the accounting equation, you can solve for any one of the three pieces if you know the other pieces. It's a basic algebraic equation. So if assets equal liabilities plus stockholders' equity, when assets equal $320,000, and liabilities equal $117,000, we can calculate that stockholders' equity is $203,000. Now let's suppose the total assets increase $10,000 during the year and total liabilities decrease $3,000 during the year. So using this same equation, here we have the original amounts, we have the increase to assets, we have the decrease to liabilities, and what that does to the affecting classifications here at the bottom. The amount of stockholders' equity at the end of the year is a change of $13,000 or $216,000. So the balance sheet presents the balances in an entity's accounts at a given point in time. The current asset accounts on the balance sheet include cash, accounts receivable, merchandise inventory. Non-current asset accounts on the balance sheet include equipments and the contra account to equipment accumulated depreciation. The liabilities on the balance sheet will include current and long-term liabilities. Current liabilities can include short-term debt, accounts payables, and other accrued liabilities. Long-term liabilities may include long-term debt. Stockholders' equity accounts on the balance sheet report the residual claims of the owners to the assets, which is also represented as assets minus liabilities. The balance sheet is one of the 4 reports that are typically generated by an accounting information system. The balance sheet reports the ending balances of all assets, liabilities, and stockholders' equity at a specific point in time. At a minimum, an organization will produce a balance sheet at the end of its accounting year. However, some organizations will report results at other intervals during the year. This is often done quarterly, even monthly. Internally, an organization may produce this report monthly, just depending upon its information requirements. The income statement captions include net sales, which is sales minus returns, cost of goods sold, which is the cost of merchandise that's removed from inventory and sold to the customers, and gross profit, net sales minus cost of goods sold. Selling, general, and administrative expenses, which are known as the operating expenses, are deducted from gross profit to arrive at income from operations, which is a really important measure of the firm's activity. Interest expense, the cost of borrowing funds, and income tax expense, which is calculated after all other items have been reported, are deducted from operations to arrive at net income. Net income per share of common stock outstanding, which is net income earned divided by the average number of shares of the entity's common stock outstanding, is often referred to as EPS, or earnings per share. The income statement captures revenues and related expenses in generating revenue. It's typically a measure of profit or loss over a period of time, and that period of time does not exceed 1 year. Some organizations will generate the statement monthly or quarterly to assess how the organization is performing or meeting its objectives. The statement of changes in stockholders' equity reports paid-in capital, which is the total amount the owners have invested in the entity. This includes common stock, the number of shares authorized, issued, and outstanding. Standing means the shares that are still held by the stockholders. The retained earnings account reports the cumulative net income of the entity that has been retained for use in the business, minus dividends. Dividends are distributions of earnings to the owners. This statement reflects the changes that have occurred over a period of time with stockholders' equity. Each shareholder is considered an owner of the organization and therefore has a great interest in this financial statement. The statement of changes in stockholders' equity is considered a supplemental statement to the balance sheet. It expands on the information the balance sheet contains. The balance sheet reports this equity section of the accounts at a given point in time, while the statement of changes in the stockholders' equity details the changes that occurred throughout the accounting period that affect this portion of the balance sheet. The statement of cash flows includes 3 captions which are referred to as activities. They are the 3 business activities. The first caption, which is the cash flows from operating activities, begins with net income from the income statement. Then we add back depreciation expense because it's subtracted to arrive at net income, but it doesn't actually require the use of cash in that specific period. We deduct an increase in accounts receivables because this reflects sales revenues that are included in the net income but have not yet converted or been received in cash. We deduct an increase in our merchandise inventory because cash was spent to acquire the increase in inventory. And we add an increase in our current liabilities because cash has not been yet paid for products and services that have been received during the fiscal period. The caption, cash flow from investing activities, or the second business activity, shows the cash sources and uses related to long-lived assets. The caption, cash flows from financing activities, shows the cash sources and uses related to transactions with our creditors and stockholders. The statement of cash flow is another supplementary statement. As an asset, the ending cash balance is reported on the balance sheet. This statement recaps where the cash came from and how the cash was used during that period. This is typically, of course, in an annual report, a one-year period. A key number to watch on this statement is whether the cash flows from operating activities are generating positive or negative results. Over time, an organization should have a positive cash inflow from operating activities. If an organization is consistently generating a negative cash inflow from operating activities, this is an indicator of trouble. Cash is mandatory, something we absolutely have to have in order to continue operations. When cash flows from operating activities are consistently negative, it translates to financing activities. Consistent borrowing to fund the day-to-day operations will ultimately cause an organization to go bankrupt because they will be unable to fulfill their debt obligations. We begin talking about some of the accounting concepts and principles and refreshing you on all of these. These are broad concepts and principles of accounting that have become generally accepted for financial accounting and reporting purposes. They include the accounting entity concept. This is a term that refers to an entity for which financial statements are prepared. Every economic entity can be separately identified and accounted for. The going concern concept, which is a presumption that the entity will continue to operate in the future. It is not going to be liquidated. The unit of measurement principle, which is a requirement that only transactions denominated in dollars are recorded in the accounting records. 4, the cost principle, which requires that transactions be recorded at their original cost to the entity as measured in dollars. Some other key concepts and principles include objectivity, the concept that refers to the accountant's desire to have a given transaction recorded in the same way in all situations. The accounting period is a concept that relates to the period of time selected for the reporting results of operation and changes in financial position. The matching concept is a concept that requires all expenses incurred to generate an accounting period's revenue be deducted from the revenues earned in that accounting period. And accrual accounting is a concept that recognizes revenue at the point of sale and recognizes expenses as they are incurred, even though the cash receipt or payment may occur at another time or in another accounting period. Other concepts and principles include consistency, which assures meaningful trend comparisons over several years. Consistency is the concept that makes it inappropriate to change from one generally accepted alternative method of accounting for a transaction to another without explicitly describing the change in methods and its effect on the financial statements in the notes to the financial statements. Full disclosure, which requires that circumstances and events that make a difference to financial statement users should be disclosed. Materiality is the cost-benefit relationship, which means that the benefit of increased accuracy should outweigh the cost of achieving the increased accuracy. And conservatism is a principle that requires accountants, when in doubt, to make judgments and estimates that result in lower profits and asset valuations. Timing is key in revenue recognition. The rules for accrual accounting state revenue is recognized at the point in time that a service or product is delivered to another entity. In other words, an economic exchange of value between two entities. The exchange of cash is not required to recognize revenue. If the product or service has been delivered to the customer, revenue must be recognized. Expenses are recognized at the point in time incurred. Cash does not need to be dispersed in order for an expense to be recognized. So, for example, your electric bill for the month of May is not received from the electric company until June and will be paid in June. The cost of electricity for May is directly related to the revenue for that month and needs to be reflected as an expense for the month of May. The matching principle of accounting dictates that all expenses related to generating revenue for a given accounting period be matched to the same accounting period regardless of when cash changes hands. Cash flows recognize revenue when payments received for services rendered or products sold, and recognizes expenses when they are paid. We have the prescribed financial statements, and unfortunately, we cannot do everything and be everything for all people. There are some limitations of the financial statements. They include the reporting of only quantitative economic data. There are some qualitative economic variables that aren't reflected, such as the value of the management team or employees' morale. Qualitative economic variables are usually subjective in nature, and they can't be qualified in terms of dollars and cents that can be verified. Some more limitations of the financial statements are the historical cost concept, and that assets are usually valued at historical cost. One of these cost concepts relates to land. Let's suppose an organization purchases land today with a value of $100,000 with the intent to build a factory on the land. Generally, as a broad overall generalization, land always increases in value. Let's assume the factory is not built at the end of the year. How should the land be valued, given that over the year, other properties in the area are now selling for $200,000? The answer to this question is that value is determined when a buyer and seller agree upon a price for an item at the time of sale. Organizations cannot revalue their assets on the balance sheet. Another limitation is the matching concept. With the matching concept, estimates are acceptable to incorporate into the financial statements as long as there is a solid verifiable basis. An example of this is an automobile manufacturer could warranty a vehicle to be free from manufacturing defects for 1 year from the time of sale. After reviewing prior warranty claims, this might reveal that 1% of all auto sales during a given year result in a warranty claim. Based on the matching principle, it's reasonable to record an expense and a corresponding liability for the anticipated cost of vehicle repairs covered under the warranty. But because it is an estimate, it is not a die-hard number. We're going to talk a little bit about the corporation's annual report. This is distributed to shareholders and other interested parties. The annual report contains the financial statements that we've discussed, together with a report of the external auditor's examination of the financial statements. And it also contains what's called the MD&A, which is Management's Discussion and Analysis. You'll work extensively with annual reports in this particular class, and you'll become very familiar with the annual report for your assigned company.